When it comes to long-term care, this big risk for your retirement, how do you know if you need protection, need some insurance, or if you're self-insured? We got that and more coming up. Long-term care, this is one of the biggest risks to your retirement, not just in retirement, but it threatens your retirement safety, security, and your ability to have a confident retirement. How do you manage this risk? That's what we're talking about right now. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Joining me in the Wise Money studio for the first time, certified financial planner and team member at KFG for, almost 10 years now, Zach Broadwick. Welcome to the studio, Zach. Thanks for being here.
It's great to be here.
So Zach is, one of our certified financial planners. He's an expert in many things, as well as tax planning and retirement planning, but also has a passion for helping manage risk in retirement, specifically long-term care and long-term care risk. Zach's originally from the Detroit area, went to school at Cedarville in Ohio.
Yes.
And you're a Detroit Tigers fan?
Big Tigers fan.
Okay. Sorry about that.
Two bad years in a row, but it's okay.
That's all right. All right, Zach, we're jumping right in the deep end, and we're going to make our way into this question, a question from you, from a fan of the show. Well, am I self-insured when it comes to long-term care insurance and retirement, or do I need some coverage? If you already have long-term care insurance, one of the trends right now is you're getting a letter, likely you've gotten a letter, saying that your premium is going up. Why is that happening? And what do you do if you get that letter?
Yeah, the why is kind of twofold in my opinion. One of them is when the policies first came out, they were under quoted in terms of premium, right?
Yeah.
So, and a lot of what's happening is they are just trying to right size. The whole idea of insurance is we're going to pay the premium in, and at some point, if we have a claim, there's a promise to pay it back. And our premiums go into a pool, right? And so that pool at some point needs to have enough where the company's actually profitable. So the first big reason is really just the underquoting of the premium.
Yeah.
After that, the cost of healthcare is inflating at a astronomical rate, even compared to, our baseline inflation rate.
Yep.
So companies are trying to keep up with that and trying not to go under themselves. So those are the two big reasons that we've seen for why we're seeing these letters. Now, the next big question is, what do you do when you actually receive one of those letters? Mm-hmm. I've seen some letters where it makes sense to continue. I've seen some letters where it makes sense to decrease the amount of insurance. Often that is an option that comes across the table. Really, that's a question between you and whoever is helping you with your finances, hopefully a certified financial planner.
Yeah.
One of the other things that we're seeing is that that modern medicine is also keeping people alive longer.
Yeah,
so
right.
The amount of time some of these policies are paying out is astronomically longer. So those are some of the big reasons, and it makes sense from an economical standpoint, right? None of us like to see our auto insurance go up, but it's going up across the board.
Yeah.
Same thing happens with the long-term care.
I was actually at a get-together over the summer, and it was a get-together for our neighbors, and neighbor's brother was there, and just chatting with him, and turns out he's an actuary at an insurance company that we have used. And so I said, hey, man, what's the deal with long-term care insurance premiums? Because yes, for a long time, so this is an enormous risk. This has the risk of you needing long-term care in retirement. We'll talk about it here in just a second. That has the potential of poking a hole in your retirement boat below the waterline. Like this is a big risk. And so 2 decades ago, long-term care insurance, standalone long-term care insurance was the primary way to go. But as Zach said, the actuaries just really underestimated how to charge for this. They underestimated how many people would use the insurance, and they underestimated how much it would cost. And therefore, prices, like you said, Zach, are just sort of right sizing. So I asked him basically just to hey, am I seeing that right? And he said, yeah, that's right. Actuaries at the beginning, we just didn't have, and he made excuses. Didn't have as much data. We weren't sure, baby boom population was just entering retirement at that age. We just didn't know. More people are using it, and it's covering more than what was expected. So this is the tension. Prices going up, but basically that means that the insurance is more valuable than what even was, what you thought. And so work with your certified financial planner. In that letter, when you get it, there might be some options where you can change coverage to keep the premium the same. Not all of those are a good idea. Work with your CFP on your specific situation. All right, so Zach, got a fantastic question from fan of the show recently about retirement planning. What are your biggest questions when it comes to retirement planning? And this individual said, long-term care. That's my biggest question. And specifically, will my investments be enough to cover the expense of long-term care, or should I get long-term care insurance? Now, I want to, before we answer that question, we've been talking about standalone long-term care insurance. What is that? What's the long-term care risk, and what is standalone long-term care insurance?
Right. So the long-term care risk is, it happens anytime you meet one of two criteria. So the first criteria is, there's what companies call activities of daily living. And those are easy to look up. And if you meet two of those activities of daily living, then you qualify for utilizing that long-term care policy.
And so activities of daily living are essentially like getting dressed,
bathing, using the bathroom.
Yeah. So
bathing,
like these are truly, that's not, even though that's a terminology, it's truly activities of daily life. Like, can you do those? If you can, great. If you have a broken arm or something else preventing you from doing those things, but you're able to get better, then that's where health insurance steps in. You can get a cast on your arm, whatever, okay? But if you have a chronic condition where you're not able to bathe yourself, you're not able to get dressed or transfer, get out of a chair or whatever, and that's a chronic condition, health insurance doesn't cover that. It might offer a little bit of coverage, but that's where that's a long-term care issue, and that's where you need long-term care insurance.
Yeah, often health insurance is only going to cover the rehabilitation side up to a certain limitation. So if you need help beyond that, that's where long-term care insurance comes into play. But there's one other factor in there, and the other factor is if you are cognitively impaired. Yeah. So the common would be Alzheimer's, dementia type of illness and often you can't meet all the activities of daily living in there as well. But that is often the other reason that you can utilize a long-term care policy.
Or a different way of saying that's the other risk where that's a big risk, and you'd want to explore, should you transfer that risk or not? So for my folks growing up, or when I became a certified financial planner, this is a couple decades ago, and I said, listen, you guys, in order to cover the long-term care risk, you need long-term care insurance. You're buying it or I'm buying it for you, because it's an enormous risk. And they ended up buying it. Now, a few years down the road, got married, and my wife's parents, a lot younger than mine, okay? And little did we know, my father-in-law was going to get early onset Alzheimer's in his early 50s. There was no plan, guys. There was no plan. Emotionally, it was awful. Financially, it was no cakewalk either. It was kind of the double whammy. So there was no coverage, there was no insurance, and it was a scramble, okay? Very, very, very difficult emotionally, financially, and he passed away after battling that disease and illness for several years. And we're still grieving. But had there been long-term care insurance, and you might say, well, at 50, he should have had it. No, at age 50, no one had it, right? And we'll talk about that here in a little bit as well. But that's the type of risk that long-term care insurance would help cover, right? So in that long-term care insurance is standalone policy. So it only covers that. Mm-hmm. It's like homeowner's insurance.
Yep. And it's use it or lose it.
Yeah.
And so it's like a lot like your homeowner's auto insurance, where you pay a premium, and if you never use the benefit because you never get in an accident, that's good that you didn't ever get in an accident, but you don't get to utilize that policy.
So the issue is that long-term care, that risk, not being able to, having a chronic condition, not being able to do those activities of daily living, or having a cognitive impairment, health insurance really doesn't help with that. It might help for a couple of days. And if you are hospitalized before needing sort of that care, then Medicare will provide, 30 days, 60 days, maybe up to 100 days. But most people, need a lot. My father-in-law needed care for about 5 years before he passed, and that's after him living with early onset for a while independently. So long-term care insurance only covers that risk. So here's the question, but it's a gamble, right? So how do you know whether you're self-insured or not? How do you know, is this a risk that you should manage and transfer in retirement, or are you self-insured? Getting back to the question.
Right. And I think it all starts back making sure you have a retirement plan that works, right? So if we have a retirement plan that works, we have a spending plan that works from your cash flow perspective, it's a lot easier to determine, okay, if I have this extra cost that might be $5,000 or $10,000 more than I'm used to spending every single month, is that going to continue to work inside of my plan? Mm-hmm. From a retirement planning perspective, one of the common strategies we like to use is we just throw in okay, what if you have 10 years of this extra $10,000 expense and your spouse is staying at home? What does that do to your plan?
Yeah.
And then you get to make an informed decision on, okay, am I okay with that, what that does to my plan, or do I explore another option, whether that's a standalone policy or that's some type of hybrid policy?
Okay, let me draw that out a little bit, what you said. Number one is you've got to build a plan, okay? And you've got to have a base retirement scenario that's very, clear, 5-factor retirement plan. If you don't know what I'm talking about, there's 5 factors that are all interrelated for everyone's, to determine everyone's confidence rate for their retirement. You can go to wisemoneyguides.com, download the 5-factor guide to get started if you'd like. But then after that, after you have a plan that works, you then need to do a what if. Mm-hmm. A what if, like this, you need to do the fire drill. We did fire drills in elementary school to prepare that if there's a fire in the school, we're ready. And so you don't know whether you're going to face a chronic illness, cognitive impairment, something like that. So do the fire drill on your retirement plan. That's what we say all the time on the Wise Money Show. Stress test your plan. Okay. Now, Zach was saying $5,000, $10,000. That comes from the national averages for assisted living. I don't know where you live, and it's all going to be circumstantial, about $5,000. Okay. National average for a nursing home, which you are going to do everything in your power to prevent or delay or never go. But if needed, at national average around $10,000. I would almost say it's higher than that, and so you need to build that into your plan to see, well, does this work or not? And then you can take this emotion, I don't want to pay the premium. Oh, I'm afraid of that. Yeah, right? Emotions on both sides. You can make an objective and say, well, does the portfolio cover it or not? And if not, you need to explore individual kind of long-term care insurance. But Zach, you said hybrid. That's the last thing we're gonna touch on here. Traditional standalone long-term care insurance. It's harder for actuaries to create a viable product there. Plus prices are going up, so no one likes it. Yeah. Okay, so if you have a policy and you're getting those love letters saying premiums going up, be careful about scrapping the policy. Work with your CFP, make an informed decision, because new folks trying to manage this risk, that standalone policy might not be a good option. What are some other ways to manage this risk?
Yeah, there's a couple ways. The first way that we started exploring is through what we call life insurance, really.
Yeah.
Right. So instead of your traditional term policy, which is normally, a lot like your auto insurance, where you pay and then there's a promise to pay in the event of a claim. So if you pass away, there's a payout. With this type of life insurance, it's covering you for your whole life. So we would call it permanent or whole life insurance, depending on the company. So we choose a benefit base, and that benefit base is going to determine what our potential payout is for long-term care. So for example, and oftentimes we write these on joint life. So if there's a couple, we'll say, okay, well, we're going to have one policy that covers 2 people. Mm-hmm. And so let's use the example of $100,000, and maybe that $100,000 policy actually has $150,000 of long-term care benefits. And in that, you're going to pay a premium to the company. But the nice part is, with this type of policy, if we pay that premium to the company, if something happens to both of you and we never utilize that premium, we get something back.
Yeah.
And back into our family. Obviously, we never see that money, but that money comes back into our family.
So if you pass away without needing to use the long-term care insurance, and there's the life insurance death benefit that is there. If you do need long-term care benefits, then you've got the benefit as part of the policy as well. So these can be expensive. Again, you've got to work with your CFP to see if this makes sense for you, but it can neutralize one of the big drawbacks of standalone long-term care insurance. And then really quick, Zach, another option is using a form of investment that's also through insurance companies. It's a buzzword where a lot of people don't love it, but it's able to offer some insurance protection.
Yep.
And it's specifically with long-term care insurance. What would you add to that?
Yep. So the other option is what we call a long-term care annuity, or an annuity with a long-term care rider. So historically, annuity, you put the money into a product, and if you can turn on a stream of income a lot like a pension, and that stream of income is guaranteed for your life. Well, with an annuity or a long-term care annuity, after you go through underwriting, they're going to offer you often a doubler or some. I think we've even seen as high as triple the benefit that you put in there to start as a long-term care benefit back to you. Yep. So yeah, annuity has been a trigger word, and especially in the Dave Ramsey culture, but it can often offer some additional protection. But
it's a tool, right? And so you've got to work with your certified financial planner who's a fiduciary, who's looking at all 6 areas of your financial life and seeing, well, what's the risk? Okay, objectively, do that fire drill. And then what are the potential tools to help solve that risk or transfer that risk if needed, if your portfolio wouldn't cover that and you're not self-insured, and evaluate each of these tools and see what the best option is. It truly is a decision where you've got to look at all 6 areas of your financial life. Protection planning, of course, that's the sweet spot where this is, but present financial position, obviously, retirement plan, we already touched on that. This has tax implications as well, estate planning implications, so you got to work with your certified financial planner on that. All around this huge, huge, huge risk that we want you to make a wise choice on. Do you need coverage, risk management for long-term care, or is your portfolio enough? Can it cover that cost and that risk for you? Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on our team. Find us online, Korhorn.com. That's Korhorn with KWise20show.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.